Good morning, everybody. This is Jerry Dory of JJ Dory. We really appreciate everyone joining us today. We took some time as quickly as we could to put this together. Dan is a friend of ours, Dan Houlf, who is the General Tax Counsel for General Motors. He's now retired and works independently on his own, advising companies. And he has taken the time to somewhat become an expert in this PPP loan and has worked through some ways, especially for companies that are looking for full forgiveness. We thought it would be, time well spent to have Dan come and give his expertise to everybody. And hopefully we find this valuable. And there is a chat, the ability to chat on here. If you do have a question, you can send Dan a chat and he will try to answer as many questions as he can. And afterwards, if your question isn't answered, you can reach out to Dan directly or through the person at JJ Dory that invited you, and we'll get you in contact with Dan. So that being said, Dan, thank you for your time, and I'll turn this over to you.
Okay. Okay, can you guys see my screen okay?
Yes.
I can, yes.
Yes.
Okay. Good morning, folks. I'm Dan Houlf. Thank you, Jerry. Today, what we're going to do is I'm going to give a brief overview of the basics of PPP forgiveness to make sure that everybody is grounded. What I am not going to do at this point in time is talk about the PPP in general. I'm going to assume that PPP is in play for you folks and that you've already gotten your loan and you're trying to position yourself so that you can achieve forgiveness to the maximum extent possible. I'm going to go through the basic forgiveness test as provided for in the statute. And I'm going to talk about some recent guidance that was issued by Treasury and the SBA. Weekend before last, they issued the instructions and the actual loan forgiveness forms. And late in the evening on Friday night, they issued a new interim rule on forgiveness that provided further insight as to how they're viewing the forgiveness tests, and we're going to talk about that in general. We will go through the clarifications and different things that we learned, and then at the end, I hope to spend some time and generally talk about some of the challenges that businesses face when they have been dealing with a reduced workforce and what they can do to help mitigate the issues that the way the formulas work and the realities of what businesses have been dealing with respect to layoffs and the fact that they have not had a full workforce during the 8-week period that they've gotten that they have to spend the PPP money. Okay. With that being said, the statute provides for I'm getting a bunch of people in here, so just let me. I gotta admit them. I apologize. Okay, the statute provides that during the 8-week period following the issuance of the loan, that is the day that the money is received, the money can be used for the following allowable expenses. Certain payroll costs are qualified expenses, wages up to the first $100,000. Is prorated during the 8-week period, which works out to be $15,385. plus certain employee benefits such as health insurance, retirement contributions, sick pay, vacation pay, and things that would fall into the category of payroll type of costs. The statute also allows for certain rent obligations to be paid with the money and be considered a forgivable cost. And the statute further provides that utility payments, which can be pretty broadly defined, and that includes internet charges, I think, cell phone charges, electric, gas, and so on, and interest on mortgage indebtedness. Mortgage indebtedness, we'll talk briefly about how the SBA has clarified what that term means. There are 3 tests right now that you have to keep in mind when taking a look at forgiveness. The first test is a ratio test, which is and this was brought about by rule rather than statute. And we'll talk about what that means. We're going to talk about the full-time equivalent test and the salary reduction test, so that you can understand what those mean and how that applies to your fact pattern. The ratio test is that only 25% of the forgivable amount may be spent on non-payroll allowable costs, such as rent, interest, and utilities. Another way to take a look at that is for every $3 that you spend on payroll, you can spend $1 on non-payroll costs. So the more money you spend on payroll, the employer, the borrower, has an incentive because he's going to get $1 to help pay for those other qualified costs. Now, this 25% rule was enacted by interim rule rather than by the statute. And there has been some talk that the SBA went too far in enacting this rule, because some businesses were hoping when they applied for the loan that they could take this money and apply it towards rent, utilities, and interest, even if it exceeded the 25% number. And there's been some talk about whether or not it's going to be challenged, but I consider that to be a little bit of a moot point, because no challenge is going to be heard and decided prior to the 8-week period getting resolved. So people can say what they want and bang their chest. As a practical matter, you have to live by the rules that they give you and apply them and assume that those rules are going to be valid if you want to be successful here. Also included is state unemployment taxes that are paid on the wages. It typically doesn't add up to be a lot. It's usually, it could be thousands of dollars, but state unemployment is capped based upon the first $6,000 or $8,000 that an employee earns. So by the time you're in the second quarter, the state unemployment cost to a business is not that great. So that's not a material item. So you've got the 75-25% rule. And this is based upon the forgivable amount of the loan. If you've got a $100,000 loan and you only were able to spend $70,000, the formula would apply to the $70,000 that would otherwise be in the forgivable bucket. It's not 75% or 25% of the entire loan amount. It's the forgivable piece, would be the amount that has been spent on qualified expenses. The second test is the full-time equivalent test. And they've got a lot of things going on in this test. Originally, they came out and said that you're going to have 2 capture periods that you can use. One is February 15th, 2019 to June 30th, 2019. and you compute your full-time equivalents at that point in time. And then you also compute your full-time equivalents from January 1st, 2020 to January 29th, 2020. And you could take the lesser of the full-time equivalents for either one of those capture periods. And so if your employment levels go down, and if they went down in the first couple of months of 2020, you'd pick that period. If your business grew, and you could perhaps be better served if you use the 2019 capture periods. And of course, Congress chose these so that the system couldn't be played, because neither one of these at the time, I suppose that one could have anticipated things by the end of February 2020. But the idea here is that the businesses, borrowers, were not going to be able to play the system here. And the statute provides that essentially that if you reduce your workforce during the 8-week period after you receive the loan, the amount of loan forgiveness is going to be reduced by the quotient of the reduced workforce. For instance, if you had 10 employees originally, and as a result of everything that's happened, the full-time equivalents during the 8-week period is now 6. You've only maintained 60% of your workforce, and that means the forgivable loan amount is reduced by 40%. And that's important because it is the amount of forgivable loan that is reduced. And the amount of forgivable loan is based upon actual spending by the business for qualified expenses. So you could take the money and spend it on payroll. It would otherwise be a forgivable cost. But if you're unable to get that FTE count up during the 8-week period, you're going to be penalized. And you're going to have to repay some of the money that you spent on the payroll and other covered costs. So it serves as a pretty sharp stick for businesses to the extent that they're unable to get the FTE count up. Now, originally, when this was passed, they didn't tell us how to compute full-time equivalents. But if you do the math, and if somebody works 40 hours in a week, on average, their FTE count would be 1. If somebody works 30 hours a week, that's on average, that their FTE contribution is going to be 0.75. So you add up the total hours for each employee, and then you do the math and you divide it by 40 times the number of weeks, and you can come up with an FTE count, and you add up all the employees, and that'll tell you what your FTE count is during the capture periods and during the covered period as well. Now, mathematically, you can add up all the hours for all the employees and kind of do a higher level wholesale type of computation to figure out what kind of ballpark you're in. And that will work, except for perhaps rounding. But when they came out and provided guidance as to how you compute this, they asked that the borrowers, employers, compute this on an employee by employee basis. Now, the statute also provided, because they understood that there were going to be furloughed employees, that if you brought the employees back and on or before June 30th, that the rehired employees then you would not be penalized for the period of time in which the employees were laid off. And the statute provides that when you compute this, you do it, or when you take into account this exception for rehires, if you rehire the employees on or before June 30th. And that's important because we're going to take a look at the guidance that's issued. And I don't think that the guidance that has been issued is totally consistent with what the statute provides for. But that's nonetheless, this is what the statute provides for. The second statutory test that they had was that you are not allowed to reduce the employee's pay. Now, this language that I have on the slide here, and we'll make the slides available to you folks, is from the statute, essentially. And the statute says the amount of forgiveness shall be reduced by the amount of any reduction in salary and wages during the 8-week period over 25% of the total salaries and wages paid to that employee in the first quarter of 2020. Now, I spent in that paragraph an enormous amount of time trying to figure out what they were trying to say. And if you go online and you see some of the discussion on this particular point, there was massive confusion as to what this means, because I didn't know if, and originally what the explanation that I heard from somebody on TV from the SBA is that this was kind of a statutory blow, because originally when they were negotiating the PPP, the 8-week period was a 10-week period. And a quarter is 12.5 weeks. And what they were doing was doing the math and saying that if you're going to take this PPP money, we want you to make sure that it goes to the employees, because it's supposed to protect their paycheck. And if you do the math, 10 weeks over 12.5 is 80%. And they said, well, we'll give you a little bit of room, but we want you to make sure that the total amount that they earned in the first quarter is going to be 80%, or 75, at least 75% of what they made in Q1. So in other words, you restore their total paycheck that they earned. But they didn't fix the statute after they negotiated the 10 weeks down to 8. There was massive confusion as to what this even provided for. And we'll talk about how they clarified that as well. And I think they provided a favorable change there, and in the guidance. Okay, so they issued some interim rules and throughout this whole process. But the big kahuna, as far as I'm concerned, is the forgiveness application that they published that is going to be required to be submitted after the 8-week period to the bank. And it lays out how they're looking at these different tests. And in the instructions, they provide insight as to how some of these things should be interpreted. And it's interesting because if you got into a court and you were to argue about whether or not these forms, in fact, are somehow binding, or whether or not they come up with a new rule and they can apply it retroactively, that's a debatable point. But when you've got to play by their game, and you've got to assume that this is all valid. And a lot of the things that they did were actually quite favorable. For instance, the borrowers didn't have any control over when they were going to get the money. If they were fortunate enough to get their applications in, got them reviewed by the bank, and I'm sure that everybody on this call will have stories about some of the issues that they had in the application process. I know I certainly had a lot of issues going through this on behalf of people. Banks would approve. It eventually went through the process. It got approved. It eventually got funded, and then it ended up in the borrower's bank account. That's technically, from a statutory perspective, when the clock started. Now, that is difficult for some businesses because it could be right smack in the middle of a pay period. And that, which means that they're going to have to do prorations on the front and back end of this 8-week period in order to figure out what was incurred and paid during the 8-week period. And that is actually what the statute provides for. It's supposed to be incurred and paid during that 8-week period. Now, the SBA came out and said that borrowers can elect an alternative 8-week period to measure their payroll costs for if you're on a weekly or biweekly pay period that aligns with your business pay periods. So you can start that on the first day of the following pay period. So on a week, if somebody got the loan on Tuesday, and the pay period typically will start every Monday, the 56-day period then would start on the following Monday. And then you can just run your course and pay people by weekly for the next 8 weeks, and you don't have to do any kind of yoga or gymnastics in order to make all this work. And it also works out favorably if you're on a biweekly pay period, depending upon where you got the money and how that fit in to this 56-day period. Because if you actually got the money on the second day of a 2-week pay period, the 56-day clock at the election of the borrower will not start until the first day of the following pay period, which could extend out the actual covered period for payroll. And that could serve as a very significant benefit to businesses when we talk about how to mitigate the harm caused by a reduced workforce. And I'll talk about that at the end of the presentation in the discussion part. So it very favorable change from an administrative perspective of dealing with the allowing businesses to elect this 56-day period. And also it allows the payroll to be paid in the ordinary course, and it says that you can pay it after the 56-day period, so long as you pay it before the following paycheck is due. So you don't have to issue payroll checks at the end of the 56-day period. You can do it in the ordinary course of business. Now, this rule only applies to weekly and biweekly borrowers. And for those that are on a monthly payroll, they're still going to have to do the required prorations. Another change is that they added or clarified that retirement contributions made during the 8-week period may be counted in their entirety. Now, there's special rules for sole proprietors, independent contractors, and partners, and they're not allowed to count any retirement contributions into this at all. But S corps, C corps, they can do that, and basically they can, depending upon where they're at in terms of their spending, if because of the reduced workforce they have some difficulty of spending the PPP money, which we'll talk about, if they have a retirement plan in place, they can stuff the retirement plan during the 8-week period. And there doesn't seem to be, based upon the guidance that's been issued, any limitation there. And depending upon the facts of each particular business, there may be an opportunity to even create a pension or retirement plan inside of a company and get the money inside the retirement plan, have it count for PPP forgiveness purposes, for the long-term benefit of the owners and some of the employees. Of course, there's discrimination rules about what you have to do in order to make all that work. And it might be costly to set up a retirement plan on an expedited basis, but they do have simplified plans that companies can consider. So that is a potential planning opportunity for businesses, depending upon where they are as they approach the end of the 8-week period. It's something to keep in mind. Now, for folks that are operating restaurants, this is kind of a big deal, is wages include tips, even if paid by the customer rather than the employer. And that's kind of a big deal for restaurants, because to the extent a waiter or a waitress get tips and that's reported on the 941 and the wages of the server, every dollar that server gets paid in tips, the business gets to keep that money and apply it as a forgivable cost. So it's that could work out pretty well to help mitigate some of the harm to the restaurant industry. And that was a gift. They also, interestingly, provide the compensation to furloughed employees, bonuses, hazard pay are legitimate payroll costs subject to the compensation limits of $100,000 annualized, even if they're not working. And I've heard a lot of people ask the question as to, am I allowed to pay people, or should I be paying people if they're not coming to work? And but through the guidance, it suggests that there's nothing inappropriate about paying people, even though they're furloughed, with this money. That's perfectly acceptable. There's nothing wrong at the end of this process if there's money left over as a result of people being furloughed and not getting paid in the front end, to take it and to give some money out as bonuses, or increasing people's pay and calling it hazard pay or something as an incentive to get people back in the workforce. And also there is no limitation as to family members. And anytime you're dealing with the government, and anytime that you're dealing with government monies, you have to act as though the transaction has economic substance to it. And if somebody brings on a spouse or a child, and the person is actually working at some level, doing something, I think that there is right now no limitation on doing that. Now that could change, and it could change the rules. Every time they come out with one of these pronouncements, it kind of changes my world. It certainly changed my weekend plans. This on Saturday morning when I woke up and found that they issued new guidance, I thought, oh Christ, I had guests, and I spent the first 4 hours of their visit in my office trying to study the provisions to see what they meant. Next is the compensation to owner, employees, and self-employed individuals. And this is kind of a big deal. Is originally when they came out with the PPP, they didn't say how this was going to work for Schedule C employees and people who are self-employed. No, and certainly we had no idea as to, even if they got the loan, what it was going to mean on the back end and how they're going to qualify for forgiveness. And you knew there were going to be rules and limitations, but you didn't know what those rules were. So they came out with a set of rules and said that if you're a Schedule C employee, which means you're self-employed, your compensation limit for purposes of computing the PPP loan and determining what amount is forgivable is based upon a limitation of $100,000 annually. And so you get $100,000, and you do the math, you get the loan, and then you're able to get forgiveness for $15,385, which is $100,000 prorated. And then you could take some of the money and use it for rent and utilities and things like that if you've got this documentation to support that. And when they issued the forms, they came out and said that if you're a owner employee, that you were limited to the amount of compensation that you could earn to the amount, the lesser of $100,000 prorated, or the amount reported on your 2019 return. And for businesses that the owner did not draw any pay, and then when this PPP came out, the question came up, can I put myself on the payroll? I'm the only one working. I'm trying to keep the ship in the canal and make sure it doesn't sink. And can I pay myself a salary? Based upon all indications, there was nothing wrong with that approach. They came out over the weekend, this past weekend, and indicated that this rule limiting the amount of compensation that could be paid to the owners applies to all businesses, not just folks that are doing their Schedule C and that are self-employed. And they pulled that one out of the air. And it impacts a lot of businesses, because a lot of businesses, the owners were in fact going back on the payroll. And there was nothing wrong with that until this came out. And I'm not even sure if the way they wrote it, that's what it means. But it very well could mean there's a limitation on the amount that shareholder owners can take out as salary during the 8-week period and be considered a forgivable cost. All right. So that was a big surprise. Next, they helped define rent. And of course, we all know rent for real estate is simple enough. I think that if you're in a triple net lease situation and you're paying taxes and insurance together with the rent, that would constitute a payment for the use of the property. All that would qualify as an allowable cost. But they made clear also that rent on personal property leases, so long as those leases were in place as of February 15, 2020, count as a forgivable cost, which means that company cars and trucks that are leased are forgivable costs, a qualified cost. Rental charges that you pay for copy machines and other office equipment, for instance, that would be an allowable cost as well. So depending upon what your business circumstances may be, having a larger bucket of non-payroll costs may be helpful. And they broaden the definition there. Mortgage interest, they defined as any interest which is secured against both real and personal property. So if it's a line of credit and it's an unsecured line of credit, that interest is not going to be considered to be a forgivable cost. But if it is actually secured, the bank has some type of security interest, the interest would be forgivable. I think that was helpful as well. And then they gave a further gift, and they said that they implied that if a company was in arrears in the payment of rent, utilities, and interest as a result of entering into this pandemic, even though the statute says that the expenses have to be paid and incurred during the 8-week period, the guidance would suggest that if you pay back rent, interest, and utilities during the 8-week period after you got the loan, that's a forgivable cost. So you might get a utility bill in that relates to, you get your money in at the end of April, you get a utility bill in, and it relates to the period prior to the period in time once you got the loan, I think under the guidance there, that's a forgivable cost. And the same with if a company is delinquent on its rent or interest, that's a forgivable cost as well. Or if you're making an interest payment and it's payment in arrears, and it relates to a period prior to the 8-week period, that would be a forgivable cost. However, it doesn't work the other way. And if you can't stack up at the end of the period and decide to prepay 4 months worth of rent at the end of the 8-week period. Okay, I'm very sorry, but I'm gonna have to let this guy out 1 second. Off to the pound he goes. Okay. All right. Now, those are some basic kind of things that we learn from the forms and the guidance, most of which are helpful. For the FTE count, they said that companies can choose a simplified method to compute the FTE count. Either each employee will either get a designation of being 1 full-time head or a half a head. In order to get a full-time head, you have to work on average 40 hours a week. Okay. Somebody works 38 hours a week, they get half a head. I'm not sure how that will all average out, but if you have a workforce that you have a lot of people that are working 10 hours a week, you get to count them as half a head. So you have to take each employee and run this so-called simplified method and figure out what your FTE count is using 1 or 0.5. And then you add those up and that will give you your FTE count. Or you can go the long form, where you take total hours worked, divided by 40, divided by the number of weeks, and that will give you the FTE count during either the capture periods or during the 8-week period. You have to run them both ways because the numbers may change. And depending upon where you're at with respect to your FTE count, 1 or 2 heads could make a big difference. Because the way the formulas work, remember that if you have 20 full-time employees before and you have 18 now, that's a 90% employment rate. You're going to have a 10% of the amount of loan is going to be non-forgivable, or 10% of the forgivable amount is going to be reduced by say 10%. 1 additional head in there is going to cut that down to 5%. So doing the math and running the computations both ways is important. And they gave employers the option to do it both ways. So that was favorable. The forms suggest that owner employees are to be excluded from the computation. Even if they were making money in 2019. And we don't know if that means shareholder employees. If you have a C Corp and the owner is part of the how do you count them? We don't know for sure how that works. And how do you, what's an owner? I worked at General Motors. I still own General Motors shares. I was, I guess, technically a 0.00001% owner. but they don't tell you, is it 20% ownership, 30% ownership, 50% ownership? Don't know. And they're going to have to come out and provide some further guidance as to how you treat owner employees, and if this is really what they're intending to do by that instruction. For the FTE count, question comes up is, I had all these people on the payroll before. I got some bad apples in the barrel. Do I have to rehire these people? And the answer there's, from the way the forms operate, is no, you don't. As a matter of fact, the people you don't like, you don't have to hire back, and you can replace them with somebody else. Because the way the FTE count is computed, it's kind of, it's an overall FTE computation, and they're not comparing, they're comparing totals for capture periods versus totals for the 8-week period. So you have the ability to replace individual employees by different employees, and there's no obligation to rehire anybody. Now but rehiring certain individuals or trying to rehire them, we'll get into one of the exceptions in a minute. Then they have the safe harbor test. If the employer is relying upon the rehire exception, it says that the instructions imply that the employees must still be employed on June 30th to utilize this exception. And what they name this is not statutory, this is part of the rules, this so-called safe harbor. They give you another test. And they say, you take the payroll period that included February 15th. February 15th, I think it was like a Saturday or Sunday. But you take the payroll period that included that day. Could be a 1-week period, it could be a 2-week period, it could be a monthly period. It really depends upon it does depend upon how your business was structured in terms of the cadence of the payroll. You do the FTE computation for the period that included February 15th. And if you rehire the employees and they're back on the payroll and they're working by February or by June 30th, and the statute says on or before June 30th, they're back and they're working the same amount of hours they were during that February 15th pay period, you're not going to get harmed if you bring them back. The problem is that the statute says that if you rehire the employees on or before June 30th, businesses got their loans starting in the middle of April, and the first batch went through the end of April, was when they actually got the proceeds. The 8-week period is going to expire for many businesses around June 15th. The instructions say that you have to have a full headcount on June 30th. It's not what the statute says, but that's what the instructions say. Which means that if a business wants to utilize this so-called safe harbor, they're going to have to make sure that these employees are all getting paid all the way up through June 30th. Not with PPP money, because after the 8-week period, they're going to be using their own money. So the businesses are going to be the ones funding the unemployment here by artificially putting these people back on the payroll, which, as a practical matter, makes the FTE safe harbor test absolutely useless for a lot of businesses, because they can't afford to bridge the gap between the time that the 8-week period expires and at the end of June. And I've got some restaurants that I'm helping, and the 8-week period expires on the 16th. And he's more than happy to take the PPP money, bring everybody back on, give them the same amount of hours and pay that they were making before, up until the time that the 8-week period expires. But he can't go paying those people full boat until the end of June, because that's out of his own pocket. And he'd be better off taking a bullet with respect to the normal FTE rules and just have the forgiveness amount reduced than of trying to apply this test, which won't work for him. And it won't work for a lot of businesses. Now, in connection with this, I spoke with a staffer from Senator Rubio's office, and we were talking about the rules. And in addition to extending the 8-week period, which we'll get to, we also talked about these forgiveness provisions and the rehire exception. And he had absolutely no clue how this operated, none. And his advice to me was, oh, I think your client should just pay all the money to the employees, and at the end of the 8-week period, he can let them go and he'll get forgiveness. I said, well, I can't do that if it's contrary to the actual forms. I just can't advise them that they're gonna just take a position which is directly contrary to the face of the actual application. He said, well, I think that was a mistake, and I'm going to call the SBA and get this fixed. And they issued that 10 days ago, and of course, the SBA isn't going to issue an emergency amendment to what they published, of pride for nothing else. So this is a real problem, and I see the gap in the safe harbor test between the period of time in which the 8-week expires in June 30th to be a challenge for many businesses. Now, if somebody was on a biweekly pay period, for instance, and since you don't have to count the 56 days until the first day of the full pay period following the receipt of a loan, it very well may be, depending upon the circumstances of the business, if you use the alternative 56-day period that they provided for under this guidance, that will bridge you to close to the end of June. But not for everybody, because some people are on weekly, and some people it still leaves them several weeks short, and businesses can't afford to pay payroll out of their own money for a couple of weeks if the employees are not adding value to the business. Now, if somebody got their money in the second tranche of PPP loans, they're probably going to be able to utilize the safe harbor exception, because their 56-day period, whether it be from the time that they receive the money or the time or using the alternative method, they're probably going to be after the June 30th date. And therefore, I think that the safe harbor exception might be helpful to them. Those who waited might be advantaged, and those that got in early may be disadvantaged because of the way this rule is being contemplated. Now, they got this rehire exception. They say, if, like, for instance, if you had the 20 employees and then you want to, what does this rehire exception mean? What happens if you go back to the employee and the employee says, I'm not going to come back to work. I'm not going to put myself in a position where I feel as though I'm at personal risk, or I feel as though that that unemployment, especially with the $600 kicker, is better than what you were giving me, and I don't want to come back to work. Okay. Should the businesses be disadvantaged as a result of that? And this is under the safe harbor test. And the rule says that if you want relief from the FTE count, because you go to the employee, you say, you can have your job back, come on back, and they're trying to make sure that they can satisfy this safe harbor test. And the employee says no, you can take it out of the February 15th FTE computation, so you have a lower number to compare to, if you follow these rules, where you have to make a written good faith offer to rehire the employee during a covered period. You have to give them the same salary or pay that they were making before, and then the employee would, if he rejects the offer, you have to let the employee know in your offer of reemployment that if they don't take the opportunity, that well, they came out, the first rule, it says that you were supposed to inform them that it may impact their unemployment benefits. Under the new guidance that came out on Saturday, it said that now you're going to have to go and you're going to have to tell you, there's going to be a requirement on the employer to snitch on those employees, go to the state unemployment agencies and tell on them that we tried to rehire them, they wouldn't do it, and you know, make so that those folks that didn't take the opportunity to go back to work are going to lose their unemployment benefits. A clear signal that Santa Claus is no longer in town. Absolutely. So something that is quite burdensome. And this applies if you're trying to reduce the FTE count during that February 15th pay period test for the safe harbor rule. Now, if an employer could otherwise rehire a different employee, then that's a way to kind of fill the hole. If somebody quits or has been terminated by cause, you can take them out of the count here as well. But this again applies if a business is looking at the safe harbor rule, which is the employment as of June 30th. And as I hope I communicated, that may not be the better alternative for businesses, given the fact that they can't keep these people afloat during that period between the 56-day covered period expiring and the end of June. Okay, so it's kind of a big deal. Salary reduction test. This was such a mess. I can't, I mean, you know, some relatively simple concept, and they made it, at least in my mind, it's so confusing. But I think this is the way the test operates. Is you take your total Q1 wages, and that includes tips, commissions, everything. You divide it by the number of hours that they worked. And that's going to give you an hourly rate. And the amount of pay that the employee gets during the 8-week period from a rate perspective has to be 75% of what they made from a rate perspective in Q1. People who make tips and commissions, you got to run the math, you've got to compute it all out, and a waiter might be making $6 an hour plus tips, but after tips, they're making $20 an hour. Well, during the covered period, you got to pay them at least $15 an hour. So if you're paying furloughed employees, or you're paying people that aren't not coming back to work, you don't pay them the $6 an hour. You pay them 75% of the wage rate that they earned in Q1 after taking into account all earnings. So, and you know, and to the extent that there's a shortfall there, that reduces your forgiveness amount again. So to the extent you didn't pay the employee what they should have gotten paid, you're going to end up paying the government, because the amount of forgiveness is going to get reduced dollar for dollar to the extent that there is that shortfall. And it's absolutely critical that you run those numbers if there is fluctuation in employee pay based upon tips and commissions. And this test applies, and this is how they wrote this, is that it only applies to those employees that made less than or equal to $100,000 annualized for any pay period during 2019. Now, what does that mean? If you have 52 weeks in a year, let's suppose that averages out to be $900 a week. One particular pay period, they earn big bonuses or commissions, and they for that one pay period, if you annualized it, they made more than 100 grand a year. They're excluded from this computation. So if somebody had a really good week or a really good month or a really good pay period, and if you annualize that one pay period and it's over 100 grand, then they're excluded from this reduction test. All right. So the upshot of all this now, the Senate has the votes, and they're thinking about extending the 8-week period to 16 weeks. The reason is that businesses like restaurants and in Michigan, and I think Illinois, there's a lot of businesses that just aren't open yet. And therefore the employers have not brought their employees back, or at least in full force, or that for the first 4 weeks of the 8-week period, the employees weren't being brought back. You start doing the math to see where you're at. And if you weren't paying the employees for several weeks during that 8-week period, and then you start figuring out what you have to do to make full use of PPP money, it's really hard to actually spend all the money, because the way things were computed is basically they paid you in the amount of the PPP 10 weeks worth of pay based upon the 2019 wages that you paid, and you're going to be paying it over 8 weeks, and then you got a little bit of fluff in there to take care of rents, utilities, and interest and stuff. So if you weren't paying your employees to begin with, and you can only spend 25% of the forgivable amount on non-payroll costs, you're going to have trouble stuffing things so that you get full use of the forgiveness provisions, which means at the end of the PPP period, you're going to have to give it back. And restaurants and other businesses have talked to their folks in Washington, and the Senate has the votes to extend this to 8 weeks or 16 weeks. And the House has suggested that they want to extend it to 24 weeks. But I think that the legislation now is stalled because there's other things that people want to put on that Christmas tree with respect to stimulus and get a better idea as to where this is going. And I don't know in the next 2 weeks, 3 weeks, which is basically showtime for a lot of businesses, whether or not this 8-week period is going to get extended. And I don't think that the folks in Washington and the people who are talking about these issues really have any idea as to how these forgiveness provisions work. Because you extend the pay periods from 8 weeks to 12 weeks to 16 weeks to 24 weeks, whatever they come up with. Fine, you spend the money, but you're still going to have this ratio that reduces the forgiveness amount if you don't bring people back to full employment. And the way the original capture periods work, it's kind of like a blended average during the 8-week period tested against those 2 capture periods. And if a business did not have their employees on the payroll for the first 2, 3, 4 weeks of the covered period after they received the PPP, you can never recover from that from an average perspective and get anywhere near on a percentage basis, up to 90, 95% of employment in order to avoid a big hit on the forgiveness piece. As a matter of fact, if people are off the payroll for 4 of the 8 weeks entirely, they're going to have to work twice as many hours as they did on average in the first quarter in order to get it back up to 100%. And that's not going to happen. It's just not, businesses aren't going to be paying people 80 hours a week. And I'm not even sure that would be appropriate, even though they indicated that bonuses and hazard pay and you could be kind of liberal with the payment of the money. These people were collecting unemployment. And if you are engaged in a scheme to basically collect an unemployment and then backfill their complete pay during that unemployment period, I'm not quite sure that would be looked favorably upon by the SBA if they actually audited this. So you got to work with some reason and substance. The old saying about pigs get fat and hogs get slaughtered. You can't, you got to approach this in a reasoned, guarded way. And when you do that, these FTE rules absolutely kill you. And what the goal now is and what I'm doing is, number one, we're taking a look really hard at the retirement provisions getting things to spend some of that leftover money, and then looking at ways to the extent that it's appropriate to stuff the hours. Like if somebody is the minimum pay after you do the computations with this 75% of what they made, the rate of what they made in Q1, it's better to pay them that minimum rate and more hours than it would be to pay less hours and more pay. And businesses have an option of kind of doing things within reason to get those hours up during the 8-week period. And the failure to plan and to get those hours up is going to result in a higher amount of forgiveness penalty at the back end when you do your computations. And I think that for a lot of businesses, they're going to find out that this so-called safe harbor and using the June 30th date just doesn't work. It's not economical at all. It'll absolutely crush businesses if they rely on that. And you have to run the numbers. You got to run the numbers. You got to develop a business specific computation to test things and to find out where you're going to land. And proper planning will allow you to mitigate some of this and to at least make sure that the business understands the import of what's going on here. I've talked to people and they're going into a blind. And I've got one guy that says, I talked to my banker and he said, don't worry about it. All these loans are going to be forgivable. They received $300,000 PPP money. They're on these restaurants. And he said, I'm not putting the time or effort into any of this because he's just going to, the banker nodded and winked at me. And I thought, well, good for you. I think you're going to be surprised. I talked to somebody else and he told me, these interim rules, I'm going to wait until everything is final and we'll figure it out at the back end. Well, okay, good luck. Because I think that not planning now and understanding what you can do to help mitigate this will end up costing you pretty big dollars at the back end. And I think a lot of businesses, when they find out the realities of how these forms operate and the realities of how sharp of an edge these reduction provisions have, they're going to end up and find that a lot of their PPP money that they spent on for employees, in fact, have to be repaid, which is going to be from 2 years at the time that they got their money. All right. So that is the slide deck. Now let me call this back down. And we've got a lot of people. I think it would be hard for me to open up the questions just to the floor, but let me see if I can take a look at some of these questions. And I'd be happy if you want to send me an email. I'll be happy if I because of the format of the presentation, it's a little bit difficult for me to just go through all the chats and answer each individual question. But I'd be more than happy to provide a form for you guys to ask your questions, and I'll try to give you what my opinion is. And I'll point out that these are my thoughts as to the way this is operating. There is these rules are changing each week. It seems like the SBA has a really nasty habit of issuing these when I'm on my third beer on a Friday night and I'm unable to otherwise appropriately respond to such, and so that you look at it and things are changing on the fly, and they have this drop a bomb on the weekend type of mentality. But the guidance is good. But things move, and there's a lot of differences of opinion because this is not the perfect scenario. Well, the one question is, do we need to have the same number of FTEs by June 30th? The average number during the 8-week period doesn't matter. If you meet the safe harbor, which is you restore, or you want to use the average as of June 30th and compare it to the payroll period for February 15th, that is the two tests. June 30th, the FTEs that include presumably the June 30th period, and you compare it with the FTEs during the February 15th payroll period, and then the FTEs during the 8-week period don't matter, and the two capture periods that you used to identify what your FTEs were don't matter if you're able to use the June 30th date. What do businesses whose customers are shutting down and not placing any orders do? They have to consider what to do if you're not getting revenue in the door, and you're not able to spend this money on qualified costs, including making sure that before $1 goes to you, $3 are going to the employees. The businesses may be in a position to either well, they're going to have to either come up with a plan to get the monies to the employees in an appropriate fashion, or give the money back. The way I read the rules actually is that this money is originally a loan, and that's the first criteria. It's a loan, and the provisions under the Act provide that you can take the loan money and apply it towards qualified costs. And they have a pretty broad definition as to what that means between February 15th and June 30th. And that's the covered period in which you're allowed to spend the loan money. And the way I read the law is you're not allowed to take that money and stockpile it and use it as a loan. And it's a good loan. The interest rate's real low, and you pay it back over 2 years, and you use it to pay the rent and utilities and buy inventory and all that in August, September, and so on. Use it to fund the business in the future. I don't think that's a qualified use. I'm not sure how they're going to police that if you don't apply for forgiveness, but you should be aware that just stockpiling the money, if you don't use it, I'm not quite sure that's allowed. That's my view. If an employee worked 40 hours per week for the first 6 weeks of the 8 weeks, is it 75%? No. If the person Yes, yeah. The question is, if somebody works 40 hours a week for the first 6 weeks of the 8-week period and then quits, is his FTE 75%? Yes. You would take the total hours over that 8-week period. And if the person quits during that 8-week period, the hours are going to cease, but you still have to, if you're using the capture periods, there's no relief for quit employees. And presumably you can get somebody else in and they could work 40 hours a week for the last 2 weeks and they would count for 0.25. It says receive the loan on Monday, the 13th. Weekly payroll is paid on Wednesday. On the 15th, but the payroll period ended on the 12th. If the payroll period ended on the 12th, you got a choice. The day you receive the money or the first pay period following the receipt of the money. And I think that you get an extra week on that, but that gets right on the edge. And I would have to take a look at the rule. I don't know that answer to the question on that without looking at the rule as to what happens if you receive the money on the first day of the pay period. I would have to study that, and I'm sorry, but I just the answers anyway. I tell you what, we're at the end of things, and I don't want to get too deep with all the exceptions and so on. So I'm going to stop it there. And Jerry and Brian, I thank you very much for the opportunity to talk to the group.
Well, Dan, thank you very much for being here. Like I told everyone, if you want to get some more questions answered, if something comes up after this call and you need some guidance, we would be more than happy to help anyone get in touch with Dan. So just reach out to the representative that invited you to this meeting. We had a great turnout. We appreciate everyone coming. And Dan, thank you again.
Dan's available to work directly with the companies if anybody really is desiring to do that in a more detailed fashion, because obviously as you get into this, you see that it can be pretty complex. So anyway, thanks, Dan.
Well, thank you. I appreciate it very much.
Thank you, everybody.
Thank you.